This conference will now be recorded.
Hey guys, what's going on? My name is Carlos Garcia, founder and CEO of G.A.R Capital. Just wanted to do a quick video for you guys. Consider this the options traders boot camp. Kind of got to go over some pretty big principles that I like to use personally when it comes to trading, and it helps out. So if you're someone that watches the morning note or the market recap after the bell, what we do at 5 p.m. and morning note at 9 a.m. So this kind of give you a little bit of an understanding of what exactly we talk about. I know there's a lot of jargon that's thrown around, and sometimes these things need to be explained so you as a trader or as an investor or someone that is interested in the financial markets can understand a little easier moving forward. So I'm just going to go over some kind of big categories on the things we talk about as a company on a daily basis. Not many other companies or services do the same things we do, so maybe a little different. But what I like to do is really focus on honing in the trading and kind of teaching that, and then helping others with advice and information so they can make their own decisions based on what we see in the market. Everything is all about perspective. I know I've been called a perma-bull before, and that's fine. That's usually the case. Sometimes I am bullish a lot. What can I say? I have a lot of confidence in the U.S. economy, but again, you have to put those kind of perspectives on the side sometimes. And the key thing is really just price action. So that's what we're going to focus on, is really kind of talk about price action, technicals, kind of a technical overview, kind of some of the things I look for. And also, if you're an options trader, I also have a list of options that I recommend that you guys can focus on. Maybe you can choose like 5 or 4 of those names, and you work on those charts, you master those charts, and then just like anything else, guys, screen time is what's going to get you better. The more you are in front of the screen, the more you start looking at your charts, even if you have a full-time job, whether it's after hours or before market opens. It's really important to see exactly why things happen the way they happen. So again, this is kind of giving you, in a sense, the language barrier if you don't understand the language of the market in terms of an equity trader, a futures trader, or an options trader. So the first thing I'm going to talk about here is ES. Now, probably everyone probably thinks to yourself, says to themselves, Carlos, all you do is talk about ES. S&P 500 futures. I do trade futures. So again, these contracts are extremely liquid, probably the most liquid contracts on earth. So again, this is a futures contract based on the underlying asset price of the S&P 500 index. The issue is the index itself, SPX, is different from ES. How is it different? SPX is just the index during market hours, 9:30 to 4. There is no after hours. S&P futures goes and trades basically 24 hours, with just a stop between 5 p.m. and 6 p.m. Eastern Standard Time. And then it does open back on Sunday afternoons at 6 p.m. Eastern Standard Time, but closes the books at 5 p.m. Eastern Standard Time on Friday. So again, you can literally trade E-mini futures all day, every day if you wanted to. And what's good about that in terms of futures is that you don't have the time decay the way an S&P 500 ETF SPY has in terms of trading those contracts. Those contracts are time sensitive, let's just say. But again, if you're somebody that has traded Forex before, I know that's how I started myself as a trader. S&P futures is a very good transition to get into understand the price action of the S&P 500, and the S&P 500 being the barometer of the entire market, unlike the Dow Jones, which is very heavily weighted with value names as well, or the NASDAQ, which is really just high growth, high beta tech companies, very tech centric. The S&P is all 500 companies, but it is still weighted. So again, it's important to understand what stocks weigh the most in terms of S&P futures. So you'll start noticing that Apple, Microsoft, sometimes Tesla, Amazon, and Google have a big part of the S&P 500 movement. So again, like today, April 21st, Tesla had a nice day after earnings, went as high as 10%. It closed up 3.23% today, but the S&P was lower. So again, it couldn't do the full heavy lifting of just carrying the actual index itself, even though it is the 5th largest stock weighted on the S&P. So again, S&P 500, if you want to look at the ticker, it's /ES. The only thing is that you're not going to get that on your Robinhood app. There's no futures there. So again, I recommend possibly using Yahoo Finance, or you can use TD Ameritrade's broker, which is what I use, Thinkorswim platform. You also have the CNBC app. You also have Bloomberg. Again, there's a lot of free charting software out there that you can have on your phone if you just want to check into where futures are at any given point, because it does trade 24 hours. Okay, let's go ahead and go over Fibonacci levels. Now, Fibonacci levels are based on a theory of technical analysis basing resistance and support levels based on certain percentages of expansion from peak to trough. That's really kind of the basis of it. So again, you can see here we do have the Fibonacci level on the daily chart for S&P futures. This would probably be the easiest way to explain. So again, you have two ways of doing it. You can do it from starting from the top to bottom or the bottom to top. That's where we'll flip the numbers. Again, it's really the same thing. It just really depends on your perspective. So again, looking at here, you have the 50, 38.2, 23.6, and then your 0. And then you have the extension 61.8, 786, 100. So 0 starting being at the apex or the top of the actual range of the past 12 months on this daily candle 1-year chart. And then you have the low, which was the Russia invasion of Ukraine lows of February 24th, being around 41.01. Right now, we are basically closed up for the session at 43.87. So we're nearing the 61.8 Fib extension. What's interesting about the Fibonacci extension is that it does sometimes provide a good barometer, if not even just an area of where resistance and support can be. Here's two examples. Right here, 43.71 seems to be holding that support the past, 6 sessions. And how about this breakout here above the 38.2, 45.38, which we stayed above for about 3 sessions. So again, that was resistance. And then this resistance here at 46.41 was rejected, the 23.6 Fibonacci level. Again, not exactly to the T, but will really give a good guide of where you're looking at in terms of the market. And then you also have different kind of chart patterns that you use. I really can't go over every single one, but here's one that a lot of people know. This one is what we call an inverse head and shoulder. So again, you have your shoulder, and your head here, but it's inverse, meaning upside down. This is usually a bullish trend, a bullish setup where we get an actual break to the upside with a possible retest of where the head actually peaked at inversely here. Now again, inversely, if you have a actual head and shoulders, which we had on the daily as well, you could see, now this is an inverse head and shoulders with a continuation. Trying to see, well, do we have a head and shoulders? Yep, right here, 1, 2, and 3, and then we continue down. So again, you do have 2 examples there. But the Fibonacci levels do help. It's important to always have a perspective when using them. But again, this kind of gives you a way to kind of see where supports and resistance can be. Remember, a support break, that could be new resistance. A resistance breaks, that could be new support, depending on the next level that you're in terms of Fibonacci levels. Right now, we're right above the 618, and then the 50% would be the resistance if we're looking at it straight ahead today. Moving averages, you're probably seeing what all these squiggly lines are for. Now, this is something that I like to use on a daily basis. So again, here's the 3 that I use, makes life easy. So when I do speak about it on Twitter or on Instagram or on YouTube or even TikTok, you guys understand what I'm talking about. The blue line is the 100-day moving average. So we take the last 100-day of the S&P 500 and we get that price and we average it out. It averages to 45.07. That does change daily with price fluctuations, obviously. If we go tomorrow, the next 100 days will be calculated. Depending on the move, this could be lower or go higher. As you can see that we're kind of drifting away. E-mini futures today, based on today's close, 45.08, 45.11 was the actual 100-day moving average, but that's been moved slightly because of the price action today being lower. So again, sometimes moving averages do creep lower or even higher depending on the price action. So again, that 100-day moving average, that blue line, look at that. To the T, it rejected it. Look at that, pretty much a couple of pennies away. So a couple of, a fraction of a point away. So with that being said, that blue line kind of gives us, again, that way, like the Fibonacci levels, a barometer to see how things are going, kind of giving us pieces to the puzzle without solving the whole puzzle. But again, these are just indicators. The next thing we have here is the 50-day moving average, which is the yellow line. Same deal, but just in a 50-day period. So the 50 days being below 100, that actually tells you that within the past 50 days, we have actually had a lower price in the S&P than we've had in the last 100 days altogether. So again, that's usually a bearish sign. We broke down below the 50. Really what defines a trend to me when it comes to a longer term trend is usually the 200-day. 200-day is a very big sample size. You're talking about 6 months, just about. Nearly 180 days, add another 20 days on top of that. So again, you're talking about 6 months worth of data in a sense of last price fluctuations. Our average is right around 44.90, which is not horrific, obviously, coming from where we were at 4,100 at one point. But again, we're still kind of connecting there. You can see the blue line is close to the red line. So again, if we can still get the short-term price action, the 50-day, to cross back above the 200-day, that's what we call a golden cross. If we have the 50-day below the 200, which we had in March, we had a death cross. The problem is that we soared. So we continued to move higher. And now, again, we still are on the lower side of the 50-day moving average. So again, it's very, very important when it comes to looking at these moving averages. Excuse me. The key is the fact of looking at the market in a totality way, looking at how the pieces move together. You can't just depend on fibs. You just can't depend on moving averages either. Again, the real deal is kind of incorporating all these moves together to define a trend, because all we're trying to do is ride the wave. We're just trying to buy something, whether it's contracts or the stock, where we can sell it later at a higher price. Whether that's puts or calls. When you're buying puts, you're buying those contracts hoping to sell them at a higher value because the actual contract is getting closer to your favor in terms of the strike price. So when we talk about with options, so again, if you just keep in mind what you're just trying to do is buy something that people want to buy as well at a higher price. We're looking for demand. So again, demand be the next thing. Look at the volume when you're talking to look at S&P 500. Let's say look at SPY, 116,000 in volume. That's really great. Again, that's it's very high for SPY when it usually gets to around 6 figures. But again, SPY usually has a lot of volume. Usually get about 50,000 a day, depending on the contracts, if there's a lot of volume. So again, I like a rule of thumb when it comes to stocks, at least above 1,000. That's usually a good sign, because I want to buy something that people are going to want to buy back at a higher price. That's really all about trading. So again, we're incorporating the moving averages. We're incorporating our Fibonacci levels to determine which is the next approach. So again, it's not a for sure thing. So I want you guys to think about it in a sense of poker. Again, you have 2 aces. That's the highest hand you can possibly get, pocket rockets, but you could still lose in the hand. You can think of this as Vegas handicapping with sports. Again, just because someone is a favorite, you know how that goes. If they lose, it's a higher payout for the underdogs. If the favorites win, it's a lower payout, but you still win because it's more favorable. Options are kind of that way too. They're priced based on where the actual asset can come close to the strike. But again, you can actually be correct in your analysis and still be wrong. How does that work? If you're trading options, understand that you can have the right analysis, but time and price are so crucial. That's really the hard part. There's many times where I, as myself as a trader, have got the analysis correct, but it's just I ran out of time. That's happened to me multiple times and I can count. But again, what you're doing as an options trader, time is always the factor. So when you're buying more time, that costs you more premium. The shorter time frame, the cheaper the option, based on time decay. So again, it's the timer starts the second you buy that option, whether it's calls or puts. Keep in mind. So there's no really easy way to trade options. There's always that risk of time decay as it goes. Even if you're right, even if you're in the money, if there's no demand for those options, you're not going to get paid, guys. So again, it's very important to keep an eye on volume. So here is a list I compiled of some of the top tickers to trade. Here's the ones I like. These are very liquid. Bid and ask means ask is what you're paying for, bid is what you're selling it for. Understand that as always. You're always clicking the ask if you're trying to buy something. Always click the bid if you're trying to sell, but they're very liquid, these option tickers here, or these stocks tickers here. Thin bid ask window, you're talking about pennies sometimes. Again, that's the spread. Easy to close quickly if needed too. Usually get a quick fill on those. So again, if you need to pull the rug on any of these trades, I had to do one today and get a quick rug pull out. Again, these are the tickers that are going to have the volume to do so. So go by your risk tolerance. Never go above 4% of your portfolio in any single trade. I highly recommend that. Some people like to put 10, 20%. If you do 20% risk every time and it's a loss, a complete blowout, you have 5 shots. Five trades, you're in the red. 5 trades, you're blown up. So again, there's no such thing as a sure thing in this market right now, especially when it's choppy. So again, you have to define your risk ahead of time. Know what your risk tolerance is. If you're sweating about an X amount of dollar, make sure to go below that. So think of a number in your mind. You're like, I can risk $200 on this trade. Think of it yourself. If I lose this $200 today, would I be in a bad mood? Would it ruin my trading? If the answer is yes, that means it's too high. If it's no and you're comfortable, then that's your risk tolerance. So here's the tickers that you have here. Apple's a great one. Microsoft, Qs, that's a NASDAQ 100 ETF. SPY, which is SPY. IWM, NEO is a good one, pretty cheap. XLF, JPM, pretty cheap. AMD, always cheap. And XLE, which is the energy ETF. There's always a little more, but I would recommend just kind of focusing on 5 and then kind of just really putting your effort and energy into kind of mastering those charts. There's one thing that I feel like I know I'm always looking at on a daily basis is S&P futures. That just works for me, helps me get a read in the market. Taking a look at the VIX. VIX is the Volatility Index. This is what we call the fear gauge. I talk about it daily. Again, it's an index. It's not tradable unless you trade VXX. So again, it's very important to obviously use your moving averages and use your Fibonacci levels if needed to track this index here to see where the mood is in the market in terms of fear. Another one I always look at is TNX. This is the 10-year yields. So the yield itself, you just move the decimal to the left. So again, 2917 really means 2.917. That's your yield for the 10-year. If you ever want to look at bonds, which I look at too in terms of bond pricing, TLT is the way to go. That's the ETF that's most traded in terms of bonds. So again, if you're bullish bonds or bearish bonds, you're looking at TLT mostly. The dollar is very important. Again, a stronger dollar has reverberations towards tech. Higher interest rates have it's very averse to tech. It hurts tech because those companies are still aggressively growing and need to borrow money. So that's something you need to understand when you're trading in a macro environment, why things are changing. The dollar index, again, is the index versus a basket of currencies. Right now, it's above 100 as of today. So again, the dollar index, rates, and the VIX are something that you should always be keeping an eye on every day, especially if you're trading futures, especially if you're an investor. Now, an investor, let me take that back. An investor, right, is simply put, invest early, invest often. The best thing is really not to touch it. You should have the same kind of approach to these companies that you're buying and the same enthusiasm 5 years, 10 years, 20 years later. Or if not, you can really put it on easy mode and just buy an S&P 500 fund. That's easier to do. Mutual funds are easier out there. You don't have to trade stocks to be successful at all. Again, these are for individuals that actually a little more hands-on approach of taking advantage of price fluctuations. That's really all it is. And again, if that's something that you see yourself doing, then again, this is something that you need to practice on. Again, you're going to get what you put in. If you're kind of half-assed in terms of trading, in terms of kind of looking at the financial world, the market's going to chew you up and spit you out. But if you really put forth the effort and actually commit to, learning, tracking your trades, understanding why things happen, and continuing your education as you go forward, then it's going to obviously work out in your benefit, and things won't be surprising as often. You'll start getting to understand how price fluctuations and even things that you thought that were random are really not random. There's a lot of kind of a structured chaos, let's just say. So I don't want you to kind of confuse investing and options or futures. Options and futures are for traders only. It's very fast paced. It takes a lot of discipline. Investing, guys, it's way easier and a lot less headache, if I can be completely honest with you. But obviously the rewards are tremendous if you know what you're doing. And if you have traded with us, great. If you have something that you've been interested in, well, glad you're watching this video. But again, join us every day in regards to the morning note and the aftermarket recap. I also blog daily on Twitter. I also put some videos up on TikTok as well to kind of explain things as they go along, because the market dynamic changes really on a daily basis. And it's up to us as a company to kind of report that information and to give you guys the perspective of what we see, as always. And again, without you guys, we don't have a company. So I appreciate all the fans, as always, supporters. I'm glad to do this video. I hope this video did help, and we'll catch you guys for the next one. Cheers, guys.